All right, let's talk about something huge that's happening right now in the world of finance. We're going to tackle a massive question. Why on earth are central banks snapping up gold at a record-breaking pace? We're going to break down not just what's happening, but the deep structural reasons why it's happening.
Okay, let's dive right in. For years, you heard mainstream economists call gold a barbarous relic, right? An old-fashioned asset with no place in a modern portfolio. But now, the most powerful financial institutions in the world are buying it like crazy. So what's going on? What's the deal with this massive shift?
And look, the scale here is just insane. In 2022, central banks bought a record 1,082 tons of gold. They did almost the exact same thing again in 2023. To give you some perspective, that's more than double the yearly average for the entire last decade. This is not a small trend. This is a huge, coordinated move in the global financial system.
So to really get this, you have to think of it like an onion. We've got to peel back the layers. And that first layer, the one you're probably hearing about on the news, is all about geopolitics. It's the most immediate, the most obvious reason for this gold rush. The big trigger, the event that really set this all off, was when Russia's foreign reserves got frozen back in 2022. That sent an absolute shockwave around the world. Other countries woke up and realized, wait a minute, our dollar and euro reserves might not actually be ours if things go sideways. Gold, though, gold is different. It's politically neutral. You can hold the physical bars in your own vaults, and it isn't a liability on someone else's balance sheet. This is the engine behind what people are calling quiet de-dollarization.
So central bankers now see gold as the ultimate financial safety valve. It's a way to be independent from a system that's looking, well, a little shaky. But is that it? Is that the whole story? Is this really just about geopolitics? Or is there something deeper, something more powerful pulling the strings?
This is where we peel back that next layer. Because beyond all the geopolitical headlines, there's a much deeper, almost mathematical force at work here. A structural driver that's way more powerful and long-lasting than any single political drama.
And that, my friends, brings us to the single most important concept you need to grasp to understand any of this. Forget the daily news, forget the talking heads. It all comes down to something called the real interest rate. This is the key to the entire puzzle.
It's actually a pretty simple formula, but it is incredibly powerful. You just take the interest rate you see on a government bond. Let's call it the nominal rate, say 3%. And then you subtract the rate of inflation, which might be 4%. The result? Your real return is negative 1%. That means your money, even when it's supposedly earning interest, is actually losing its buying power every single year. When that happens, holding government bonds becomes a guaranteed losing game.
And this is where it gets really, really interesting. Just look at the history here. The pattern is so clear it practically jumps off the page. Back in the 1970s, when real rates were deeply negative, gold's price absolutely exploded, up over 2,000%. Then in the 80s, Fed Chair Paul Volcker jacked up rates, real rates went positive, and boom, gold crashed. Fast forward to the 2000s, real rates went negative again, and what happened? Gold soared once more. It's a clear, undeniable repeating pattern.
Okay, so that brings us to today. Where do we stand right now? Well, Japan is already locked deep in negative territory. And the US? Yeah, it's positive for now. But with the Federal Reserve already signaling rate cuts, you can see which way the wind is blowing. The central banks, they see this writing on the wall. They know that the world of negative real interest rates means holding government bonds is just a guaranteed way to lose value. And that is exactly why they're turning to gold.
Okay, so this is the real million-dollar question, isn't it? Why should we believe this environment of negative real rates isn't just a temporary thing, but a structural feature that's pretty much baked into the cake for the next decade or even longer? Well, the answer comes down to two unstoppable forces.
It really boils down to a massive one-two punch. First, you've got demographics. Think of this as gravity. Advanced economies like Japan, the US, and even China are aging, and their workforces are shrinking. That puts a natural, heavy brake on economic growth. And second, you have mountains of government debt. Japan is at 264% of its GDP. The US is at 120%. They simply cannot afford to raise interest rates in any meaningful way. Their debt payments would spiral out of control. This puts them in a trap. They are forced to keep interest rates low, even if inflation is high, which basically locks in negative real rates for the foreseeable future.
So if we accept that we're locked into this new reality of negative real rates, what does that actually mean for the price of gold over, say, the next 10 years? The analysis points to a few pretty clear scenarios.
All right, scenario 1, the base case. This is the most likely outcome, about a 50% chance. It's basically more of the same. The current environment of kind-of-sort and negative real rates just continues on. In that world, we could easily see the price of gold double or even triple from where it is today.
But what if things get a little spicier? What if we see a replay of the 1970s with much higher inflation and people starting to lose faith in paper money? Well, history shows us that's a recipe for some truly massive moves in gold. A 5 to 10 times increase isn't just some wild fantasy. We've literally seen it happen before under similar condition.
And then there's the extreme scenario. Look, it's a long shot, maybe a 5% chance, but you can't ignore it entirely. We're talking about a full-blown crisis of confidence in the global currency system. In that case, even higher multiples are definitely on the table.
Okay, we've gone through the why, the geopolitics, the deep structural math. So what? What does this all mean for you, for your money? How should you actually respond to this information?
Well, the analysis suggests that having a pretty serious slice of your portfolio in gold, we're talking 15 to 25%, isn't just some speculative bet. It's a prudent move. It's about hedging your wealth against this long-term structural reality of negative real rates and governments that are drowning in debt.
And how you do this is absolutely critical. This is not about getting in and out, trying to time the market. It's about getting in sync with this deep structural cycle. First, that means you hold for the long term. Think 10, maybe 20 years. Second, you have to completely ignore the short-term price swings. A 20 or 30% drop, that's just noise, not a change in the big picture. And third, and this is crucial, you need to watch the right numbers, the long-term trend in real interest rates, not the daily tick-tock of the gold price.
And you know, this quote really brings it all home. The central banks aren't trying to predict what gold will do next month. They are reading the long-term equation of the world economy. They see the unchangeable rhythms of demographics and debt, and they are lining up their strategy with that reality. So the question for you is, are you going to do the same? Are you watching the short-term waves on the surface, or are you paying attention to the powerful long-term tide underneath?